This is The Wealth Puzzle with Michael Mansfield from the Lynn Group. When a part of your financial strategy is out of tune, your long-term goals, your retirement savings, and your legacy can all suffer. With many years of experience in the financial industry, Michael provides his clients and prospects with the information they need regarding Social Security, retirement income planning, wealth management, and much more. Listen in as we address your financial concerns and provide helpful solutions to put you on the path to achieving your retirement goals. And now, here is The Wealth Puzzle with Michael Mansfield.
Hey everybody, thanks for tuning in. I know it's been a couple weeks since I made a video, but Owen's been doing a great job covering me. But holy cow, has it been a wild time in the news and the markets. A little bit of vindication. Go back and watch my previous videos earlier in the year. The argument was market would recover. It would go up to probably around 7,300, probably get pouty as the new Federal Reserve chairman changes, and then push higher. And if you've been in meetings with me, we've been talking about this a lot. I think the S&P is geared towards 8,000 at the end of this year. And that's kind of creates a brain fart, right? We turn on the news. We're in World War III. There's chaos everywhere. Everything is falling apart. Chaos, chaos, chaos. And yet, why would kooky old Mike say the market has the potential of going up so much? And it's because we put so much time and energy into the chaos side, the emotional side of the market, that we don't focus on the boots on the ground of what's really going on. And so here we go. Here's a chart of the S&P 500. It's a pretty simple read, we'll say. Let me turn on a line. Obviously, right here, we had World War III starting. We've got a couple months of the market trending down. Wasn't an insane pullback. It was barely considered a correction. From peak to trough, the market went down 9.7%. And then it said, just kidding, and went straight up. And it did it for a couple reasons. One is obviously anytime we think or thought the war would soften, that there was a ceasefire that created an emotional relief sigh. But at the same token, what's really quietly happening is all of the data behind the scenes is turning, and we are so consumed by watching mainstream news that nobody's really focused on the data and probably the effective data that's extremely useful here. For example, we are smack dab wrapping up earnings season. So as of today, it's about over. The last formal update I have on FactSet is May 8th, so it's a few days old. But even when we ran this, 90% of the companies had already reported earnings. But what's crazy about this is when reporting earnings, obviously we're watching all the data. Remember, the stock market is a barometer of emotion in the moment. We turn on the news, we get upset. At the end of the day, the stock market is a barometer of the earnings of companies and the profitability of companies, period. And so in this earnings season, it's been great. 84% of companies have had earnings above their estimates, which trends well above the 5 and 10-year highs, which is cool. Those surprises have been dramatic, but this is what's nuts, is year-over-year earnings, the blended, combined, blah, 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 earnings growth rate for the first quarter at the moment is 28% year-over-year. Last quarter, when we just finished up in the first quarter, in the beginning of the year, 13%. Earnings are basically double right now. Earnings are accelerating right now. Companies are making more money. And the reason this gets confusing is if we look at earnings, yes, is there a lot of tech money floating around and a lot of wild things going on? Absolutely. But at the end of the day, when boiled down, the U.S. economy, 70% of it is consumer spending. People spend money. We are a consumer economy. And so whether good, bad, indifferent, these companies are generating a lot of revenue. People are spending money. Things are moving around. Like I said, that's confusing because we're told the labor market's collapsing. We're told people have no money. So where is all of this money that is being spent? It's quite a conundrum at the moment. But honestly, fascinating. Just shocking that earnings are accelerating when we watch the news and everything feels so upsetting. These are the best earnings we've seen in years. So that is a big component of what suddenly made the market go, haha, just kidding. Even though we were being emotional based on the headlines, we now have all of this extremely strong data. And as earnings get revalued and repriced, it creates a much stronger fair value for the stock market at the end of the year. So there's piece number one. The other thing that we've heard for years is that manufacturing is falling apart in the United States. which is very true. There's offshoring, there's cost structure issues in different states. This is the producer manufacturing index. And so if you can look at it right here, you see the bar on the right side of the screen is the tallest bar on the page. Even this is 1 year. If I go out 3 years, it's still the tallest bar on the page. Out of nowhere, quietly over the last couple months, all of the sudden manufacturing is accelerating in the United States. Something that everybody said really could never be done, that it would become positive, it would become exciting, there would be onshoring. The riddle wrapped in an enigma. It is happening. We're starting to see manufacturing turn into a very positive light. Now it's in its infancy, right? That's only one big bar out of many lower bars. And so is it an anomaly? We'll find out. But this was very exciting and very interesting to see shaping up over this last quarter. So awesome news. Once again, we have strong earnings. We have manufacturing tightening up. And then you get to the labor market. Over the last year, we have these little pluses and minuses of good day, bad day, sparse earnings on all the jobs being created, the payrolls. And all of a sudden, we just had 2 oddly strong months. 185,000 jobs in March, 115,000 last month. To put that in perspective, the market had estimated in April here there would be 55,000 created. There was 115,000. Once again, we have a long way to go to stabilize the labor market, but this is good news. How is it that during World War III and all the chaos that all of a sudden companies have confidence to hire? That is kind of confusing, but it's because there's subtle things going behind the scenes that are really effective for the economy right now. And so here we are. Earnings are extremely strong. Manufacturing is improving. Labor market is tightening. These are all the things that are screwing with our minds on why is the stock market going up when I feel so emotional that it should be going down. And then we get to pesky inflation. So inflation came out this morning. It came in hot. Honestly, let's be fair. That's probably pretty expected, right? Gas prices have gone up. And so what you see here is you see a blue line and a dotted line. The blue line is consumer price index that includes food prices and energy prices. And so they take the monthly read, they times it basically by 12, and that's the annual rate. So current inflation per the government is at 3.8%. Then what they like to do is they'd like to put on this little dotted line here that takes out the energy prices and food prices because they feel those are volatile. And if you strip those out, they're saying inflation is 2.8%. Go watch my old videos. I've talked about inflation quite a bit. And one of the things that I've talked about quite a bit is in the government's version of CPI is a lagging indicator. It is using old news. It is using old data. It is very problematic. They figured out how to calculate this like 20 different ways since the 80s. So they're always being creative with it. And one of the biggest lagging indicators when the government does their surveys is just rents. If rent came down, well, if someone's locked in a rent for a year or two, obviously their price didn't come down. So it doesn't properly calculate what's happening in real time. Well, good news, there is real-time data. And the largest provider of that is an outfit called Truflation. So what Truflation does is they don't use the surveys like the government. They don't use the lagging data. They have over 4,000 immediate real-time data points that they look at to assess current consumer price inflation. And what's amazing about this is they say, if you go read about it on the old interweb, that this has about a 99.8% correlation to the CPI of where the CPI, the government CPI, is going, right? So this is like an early read of reality on the ground. And you can see here, I'm on this 1-year chart on Truflation. It's saying as of a few days ago, Truflation's at 1.93%. You're like, well, wait a second. No, the government just told me it's at 3.8%. That's if you're looking backwards. In real time, it's at 1.9%. I know that feels weird and confusing. But even if you look at the chart, in February, it was below 1% annualized CPI, and it's been increasing. So once again, same idea. Energy prices are going up. Food prices are going up because of the war. So we have seen the increase in inflation. So inflation is, in fact, elevated. So the government's chart is not wrong, showing it perking up here. The problem is the government's chart is probably wrong because they're using old news data. Well, fast forward the thought. We have high frequency data. At the moment, it's saying that inflation is genuinely lower than the government realizes. Now, you and I might have a different opinion if we want to go eat at Hamburger Habit or go to Vaughn's or something, but that's okay. And then that gets us to kind of the final thing. So this morning I was looking at the Fed rate watch tool. This is how we look at the probabilities of if the government's going to cut rates or not. We have the June meeting coming up here pretty quickly. There's no rate cut in sight. But as of, let me go to the end of the year. As of this morning, when that government's version of CPI at 3.8% came in, all of the sudden, instead of having a rate cut this year, it created a 35-ish% probability that we could have a rate increase by the end of the year, which is kind of shocking, right? We've been talking about cutting rates. We've been talking about Kevin Warsh coming in and stabilizing that kind of stuff. And it's going to be very interesting if he gets the official confirmation, goes into the Feds. Does he in fact come in? What is his attitude? Is he going to raise rates? Is he going to cut rates? But I would make a quiet argument that unless we saw a very rapid acceleration of the M2 money supply, I'm going to put my mind power towards the fact that trueflation is probably more accurate of where inflation ends up later this year. So to that point, I just wanted to come in and quail some of the ideas because I've been fielding a lot of phone calls on why. Why is the stock market going up so much? This is scary, overwhelming, confusing, doesn't make any sense. Is this a good time to sell? It's never a bad time to sell if you need money when markets are high. So this is a great time to create some liquidity if you certainly need some money for something that you have going on. To that point, though, I have a lot of conviction that by the time we get to the end of this year, I don't think markets go in a straight line. Once again, I think it's going to be probably rocky in the summertime because history says that when a new Federal Reserve president comes in, the market tests that person for at least a couple months as they announce all their new policies and things like that. So that wouldn't be a surprise to me. But at the same token, like I said, I think that over the next year or two, we're probably going to see a very solid market and a lot of potential. Do we not have high level issues going on? Yes, we have national debt issues and dollar strength issues, and all of the usual suspects are there. The problem is those are long game issues that need to be sorted out. But in the immediate term, there seems to be a lot of positive things going on in the underlying economics that drive the actual stock market. So that was the State of the Union for today. I hope you all liked it. Let me take this off. And if you got any questions, thoughts, concerns, just give us a call. Reach out to the office, our main website, thelindgroup.com. Lind is Lynd. And everybody, I hope you have a great day.